Hello traders, this is my weekend video, and this is just gonna give you a recap for the first of the year because we're gonna be changing over in the middle of the week. And the main thing I want to bring out here: do not get fooled on this relief rally in the markets at all. And this is the first time in the since 2008 crisis that we are outright threatening a yield inversion on our different time frames. I've got my on the area chart. That's my 2 year. The red one's 5 year, 10 year, and 30 year. That's what I have on my chart here. And we are going to be starting the first of the year with the potential of the 2 year inverting over the 5 year. Right here, right now, we've had some inversion in December here, but right now the 5 year's trading a few pips above the 2 year. It's still it's not inverted quite yet, but here we are going into the very first of January with this situation lingering over the markets, and this is very bad for the banks. Basically, you need like a 10 pips spread for the banks to make money, and we have basically what we've got going on here. We have a massive squeeze in the yield curve here, which is going to significantly impact the ability for banks to make money this quarter. So we're likely to have some really bad returns from the banks coming into first quarter earnings because of the tightening yield spreads. So very dangerous situation here for the banking sector coming into the first of the year. And basically, we're seeing that since the chairman of the Fed's already said we're only going to do 2 rate hikes next year, and the markets are already predicting only 1 rate hike based on the market conditions, we're going to be seeing our rates coming in down to this trend line most likely in January. So just keep that in mind that rates are going to likely to continue to decline in the first of the year, and that's going to be bearish for the overall markets. Now, in that scenario, if you look at your XLF, we have managed to come back up to our yearly value from 2018, from 20 that developed out in 2017 for our financials. And if the inverted yield curve or lower yields hit the market in January, which I think is going to happen, we are going to probably see we're going to come down here and retest this primary trend line in January. So I can't say for sure in January, but pretty good chance we're going to be coming down to this primary trend line in our financials, and that's going to drag the entire market down with it. Another area of great concern this week, and that's our transports, our IYT. And a main thing I want to get is the slope of this accelerated monthly uptrend and how fast we have come crashing down back to this trend line off of this accelerated slope in our transports. I, for one, think we are putting in a longer term topping pattern in our transports here. I can't say for sure we're going to become crashing down, but just keep this one on your radar. We're right at we're not getting above average volumes quite yet. We did have some PMI numbers that hit the tape Friday, and there was a report out saying that they still had solid backlogs in the industrials. So that might be. It was given a little bid to some of the industrial sectors like Boeing and Caterpillar because of the solid backlogs report. But they also reported that the supplier, uh, yeah, the supplier orders hit a year low, the year lows on the supplier front. So, and they cited they still had high inventories for a lot of the industrials. So like the autos and stuff, automotive sectors and stuff, they're sitting on high inventory levels right now. So just keep that in mind that the transports are a leading indicator, and hearing that the suppliers are having very weak order flow right now, this is a very dangerous situation going into the new year, because the suppliers are the one, or the transports are the ones that bring raw materials and basic materials into these manufacturing facilities. And if they're already sitting on high inventories, it's going to be very difficult for the transports to maintain these lofty levels um, going forward into the first of the year. So that's one of the scenarios I did want to point out. Uh, a lot of risk. And Thursday we had the manufacturing PMI numbers coming out. Very, very, very important for the first of the year. So just keep that in mind. That's your purchasing manager's index. And like I said, the suppliers are hitting year lows on orders. So that suggests uh, continued weakness later this week in the transports, if they confirm the news that hit Friday. Just so you know, here's how your industrials are playing out here. And hearing that news that the backlogs were still solid, it's helping out some of the industrials. But just keep this in mind here. We do have a wedge formation, and we have broken down from the breakout levels of this wedge pattern. So just keep this on your radar. We are inside the wedge, so until we start breaking down below the wedge again, we've already been there once this month already, and we're going into January with all kinds of risk, especially in the financials. So very dangerous, and we are getting above average volumes the past 3 months on the industrials. So that's another red flag that the industrials, they're on a sell signal so far. Yeah, and before I get too far away from my financials, and I jumped over into the industrials. I'm sorry about that. But you see what we have got going on here on our high yield bonds. Look at these volumes in the high yield. They are red flagging serious trouble in the markets. And this is a red flag of liquidity issues in the high yield area in the market. Major red flag. The Federal Reserve is reducing their balance sheet. And I had said before the Fed came out on their meeting that night before that if they did not stop the reduction in the balance sheet, that the markets were going to sell off. And that's exactly what happened. And they don't have any indication that they are going to stop in the near term. And this right here is a major red flag that there is a liquidity issue in the high yield bonds. And another thing that showed up Friday morning and really shocked me, in the top 5 leading volume leaders, HYG. It was a leading volume leader in the Friday session. And high yield bonds don't typically ever uh, show up as a leader on the leaderboard. So just keep that in mind. There is all kinds of people who do not trust this bounce in the rally, and the bulls and bears are in extreme battle right down here at these range lows, deciding whether to push us higher or push us lower. And given these volumes, I am leaning to the downside. I think we're going to become first of the year. We're going to be coming down to the 7506 area because of the major liquidity issues in the high yield bond arena. And this is what's really kicking off the selling pressure in the markets, the high yield bonds. Okay, what we saw Friday, because you don't want to get too wrapped up in these uh, bear flag rallies, and you see how the Qs have just went parabolic since the 2008 collapse, and we're coming crashing down on above average volume the past 3 months. Here we are starting the first of the year. Do you guys really think it's going to be over January 1st? That the selling pressure is going to stop? I don't know about that. But what we saw happening Friday was the advancers on the Qs and advancers on the Russell, which are the more risk on areas. They were catching a short squeeze in the Qs. So just keep that in mind that we did have a short squeeze situation hit the markets there on Friday. And that's all I think it is. I think it's a short squeeze. And if you change your time frames down here, 1 second. And basically, we came down to this high volume point of control on the Qs, and we found some responsive buying, and we're right here at the sell point. It is no coincidence that we're finding resistance right here on this is our yearly value areas. Okay. And we came right up here for the month and right here at resistance. Okay. So just keep this in mind on your Qs. It wouldn't surprise me to see us close a little bit higher there Monday, right here on this trend line to start the first of the year, and we'll see what happens. But I do think Monday is going to be a relatively flat day, flat to lower day, because this is a sell signal. This is the range highs for 2017. Yeah, 2017 range highs, and so just keep this in mind. Quite a bit of risk here going forward. Now, what really happened there Friday, and that was our FANG stocks caught a bid. And we had above average volume again on our FANG stocks, our internet stocks. And they were leading the board as of Friday. We saw some Amazon mainly. Amazon is a major driving force at these range lows. Any other time I could do this. 1 second. Okay, our FANG names, we did try to push out higher, and we came to this trend line, responsive trend line in the past, and we actually closed slightly lower on our FANG stocks for the day. And I still think we're going to be right here trading inside this range, Friday's range, come Monday. And then the markets will decide January 1st which direction to push the indices. But still, the FANGs were catching a little bit of a squeeze. But you go out there on that monthly, you see how these FANG stocks have just exploded. Look at this parabolic move on the FANG stocks, and we're still in vertical. This is virtually vertical on this uptrend. If this does not scream trouble, I don't know what does. I mean, this is the textbook definition of a topping formation. Textbook. So you had this situation, we had a little bit of a bounce right here, but very dangerous coming into the first of the year that traders are going to move out of the FANG stocks this year, and the FANGs are all coming down to much lower levels. Okay, here's another one. Your SMH. This is your semiconductors, and we did manage to get back to the it was the 2017. It developed out the volume point of control that developed out for 2017, and the semiconductors managed to rally hard right back to the value area point of control. This is still not overly bullish, but I do want to point that out. And then I did also forget to mention something about the 125 SMA. I'll do that here in a minute on the other charts. So, but at any rate, there is value at this point. That's why I don't think we're going to see, and we're at the 50% fib. So we've come off the 61.8 sell off all the way back to the 50% in 2 days. So I'm thinking we're going to see more chop in this area on the SMH. Look at the above average volumes again. Major red flag, major. Even more so than our transports. Okay. You see volumes like this, that is typically a continuation setup for lower prices. So just wanted to point that out that We have retested a critical um, support area, but that doesn't mean that we're not going to be coming right back down to it and testing it again. So just wanted to let you know about that. Okay, our XRT, we're getting above average volumes again on our retail sector. Okay, and Amazon is heavily weighted on the retail sector. And what concerns me, we all know Christmas was good, but markets are forward looking. And look at how fast in 2 months we have crashed down in 2 months the entire range. And the markets are already expecting good numbers on earnings. So why is this crashing like this? I mean, it's a major red flag in my book that this higher distribution area is in jeopardy of breaking down for the retail sector. So that's another one I wanted you guys to look at. Okay, another thing I like looking at is how the major sectors and the major indexes are relating towards the 125 SMA. CNN Money, that's what they use as the critical indicator between bullish and bearish scenarios. And so far, the SPY SP 500, we are still below the 125 SMA for the SPY. So a retest of that 125 SMA, this even if it happens tomorrow or Monday, the 252.30 area, that's still a short point. Unless we get a closing price above that, you would still want to lean to the short side in these into the S&Ps. Look at your IWM in relation to the 125 SMA. This is an extremely bearish pattern in our Russell. So, but we managed to have an oversold bounce right back here to range lows from the value area that developed out in 2016. So this is our 2016 value for the Russell. And we managed to rally right to the bottom of that range as of Friday. So this is just something to keep on watch here. Are we going to trade inside the 2016 range? Or is the market just going to fall apart here and completely reject the 2016 range for our Russell? So that gives you a little idea of why some buyers were speculating and coming into the Russell as of Friday. And our Qs, we managed to poke above the 125 SMA. So our Qs are showing some initial bullish indication, but we are ending the year totally rejecting the 2017 value, correction. We are at the range highs of the 2017 developing value. Okay, so we are at resistance, but we are above the 125 SMA. So this has given us a mixed signal here that the markets are not sure what they're going to do with the Qs. S&P, yeah. So in my book, I think the Qs are going to come back down, largely because of the semiconductors. I think the semiconductors, the news out that the suppliers have over inventory and the supplier orders are at year lows, that suggests to me that the semiconductors are way too overvalued at these valuations, and we are going to be coming back down to the 133.35 area here real soon for the Qs, the first of the year. Another one, our diamonds. We're just like our Qs. We are pinned between the 2017 value area. We're not at resistance yet, but we are above our 125 SMA. So this lends to the bulls until proven wrong. So just something to keep in mind there. which areas that will show more relative weakness than others. And so just keep this on your cards, some ideas that I'm floating out there. So basically, the core backbone of the markets are your IYT and your SMH, and both of them are under the 125 SMH, or yeah, uh, simple moving average. Okay, SMA. And so just keep that in mind that whenever you're driving sectors that support the markets are not even above in bullish territory, that this is absolutely a bear market rally until those sectors can get back above their 125 SMAs. And I'm going to finish off here with our energy sector. That's another one. We're right here, below 125 SMAs. And we are inside of the 2016 trading range. So we've completely wiped out 2017 and 2018 value. So just keep that in mind that uh, a lot of risk in the markets here. So just wanted to give you a heads up here. So basically, if you haven't noticed, I'm bearish the markets, and I think the situation with the interest rates is critical. And unless we see some immediate resolutions in some of the talk out of Washington, which I don't see coming, I see a disastrous situation setting up for the first of the year. Okay, please leave comments below. I really want to hear your feedback, and maybe I can learn some stuff from you guys. And share my video if you get a chance. And I'll try to give my midday videos all week long this week. Talk to you later.